Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. We've been talking a lot about bonds, fixed income, and also talking a lot about the role of bonds in your portfolio and the types of bonds we would recommend. Most importantly, bonds are often used as diversifiers away from the market to help dampen the volatility. But to say that this asset class has been very challenging over the recent past is an understatement. Actually, I looked up the 10-year bond yield, Steve, today, and I think it's somewhere around 1.24%. That's in case anybody's watching this August 2021.
21.
Of course, we're not getting a lot of yields out of these bonds. And that's why we have to keep reminding ourselves, well, why do we have these bonds in our portfolio anyway? Well, there is some justification in having that conversation. And we've been spending a lot of time exploring where else we can get diversification, but also have some potential upside. And so we found one asset class that we'd like to talk about today, which is a type of bond. It's called a reinsurance bond. And so I think maybe we should show them the universe of types of bonds, right?
Yeah, and also, a little bit later in this video, we're going to talk about the challenge that the bond yields currently pose to the classic 60/40 portfolio. And that's one of the reasons why we've been trying to find other ways to create that second bucket, because we believe in that three bucket theory. The first bucket's cash, second bucket are safe bonds, and the third bucket, of course, is the growth components of your portfolio. And so in this chart here, which we've been using, we sort of show a chart of the different types of bonds. We've added in the center what we call non-traditional bonds, and that includes convertible bonds, which that'll be the topic of another video, and reinsurance catastrophe bonds, which sounds like a terrible name, doesn't it? Catastrophe bond.
Well, it's a type of risk, right? And so one of the things that Steve and I like to focus on, and we really believe is the nut and bolts aspect of modern portfolio theory, is finding asset classes that have different risks associated with them, so that we're exposing you to risk. There's no way around it. You're not going to get a higher return if you don't take on some kind of risk, but different sorts of risk that would most likely never happen at the same time. So that's what makes this such an interesting asset class.
And we're always really cautious in trying to understand the sources of risk in any type of investment. So here's a little bit of history and a brief summary of catastrophe bonds or reinsurance bonds. They were actually introduced around the early to mid 1990s as a result of some bad events. For example, some hurricanes and I think an earthquake, and there's some issues with insurance company balance sheets, and they realized that they need to strengthen their balance sheets and be able to transfer some of these risks they had to other entities that could help absorb those risks. And so they created this category called a reinsurance bond, the structure of which, by the way, we're going to explain in another couple slides. But these are the characteristics. They do have high rates of return. The risks of these bonds are not really correlated with pretty much any other type of asset you have in your portfolio, which is why they're so unique. They do have low ratings, and we're going to explain why they have low ratings. Their BB rating and below is not because for the same reason, for example, that a high yield bond has that lower rating. It's for a different reason, and it's because of a different type of risk, not default risk, another type of risk. There's actually no. Oh, go ahead, Laura.
I was just going to add, when you were talking about the fact that they're not highly correlated with other asset classes that we use in people's portfolios. They're also the risks internal inside the overall portfolio of the reinsurance bonds are also not correlated. And so that's important to think about too. The chances of there being a fire in California and an earthquake and a flood in Florida and a tornado, and like all at the same time. Well, I mean, I guess it could happen, but there is some balancing off of those different hazards.
I think probably an asteroid would have hit the Earth at that point.
Yeah,
So
and zombies.
yeah, exactly. And the interesting part about in reinsurance bonds is there is actually no counterparty risk. And that's where the bulk of the risk comes from a high yield bond, is that counterparty risk. Counterparty risk means that that's the risk that the bond, the entity that issues the bond actually defaults on payment of the principal on the bond. And by the way, these bonds are typically floating rate bonds as well. So the interest rate changes with rates, and they kind of maintain their return with respect to inflation and other factors. So we've already touched on a little bit on the benefits of reinsurance bonds, why we feel are so important in someone's portfolio. They add diversification benefits, especially when we experience bad events like 2008. And during events like 2008, we typically find that things like corporate bonds, high yield bonds, and other types of bonds like that have counterparty risk become highly correlated with other investments in a person's portfolio. What we mean by that is they tend to drop like the stock market, which is exactly what we don't want in a portfolio for bonds. Okay, they experience reduced drawdown. Drawdown means the difference between the peak of one's portfolio all the way to the bottom after it's fully declined. It reduces that drawdown amount. Improved average, what we call tail risk, conditional valued risk. That's the average loss you experience in the worst economic events your portfolio will experience. There's a dramatic reduction of this. And there's also an improvement in portfolio efficiency, which really means return versus risk level. And by the way, this comes from an academic study, which we highlight below here.
But even if you use just common sense and logic, and you think about, okay, in 2008, for example, there was a market correction, and all the financial assets were all related to each other within this market correction. These reinsurance types of bonds had nothing to do. They were not going to be affected by a market correction. They will only be affected by if there's a natural disaster again. So it's a completely different place that we're sourcing this risk.
And that's great, because that risk is, like we say, is not tied to the economy. It's not tied to other types of risk, including counterparty risk. And so how are they actually created, reinsurance bonds? Well, a sponsor, as you can see from this graph, I know you may have trouble reading some of the fine print in it. Sponsors, typically an insurance company, looking to transfer some of their risk, for example, hurricane risk, to someone else. So this special purpose entity is formed specifically to issue bonds, which investors purchase, and those bonds, which are held by the special entity, they're not held by the insurance company, which is why there's no counterparty risk, are typically invested in things like treasuries. But the insurance company, which is in orange, the sponsor, pays a premium to the special purpose entity to actually have access to that capital if they do experience that risk. And so that's where the risk in these bonds does come from. If there is an event, for example, a hurricane or an earthquake, the investors may not receive all of the principal back from the special purpose trust. They may only receive part of it back. But the advantage to this is they can buy many different types of reinsurance bonds issued by many types of these special purpose entities. And that way you have different types of risks altogether. Risks of a hurricane that hits Florida, risk of an earthquake that hits California. So you're diversifying the risk away. And there have been very few instances, by the way, of these special purpose entities having to release the entire amount of capital to the insurance company. It's been very rare, by the way. So there has not been a dramatic amount of risk in that area.
Right. And if there's no covered event at all, they're redeemed 100%. So you're getting, well, so it can be very, very profitable at times.
And by the way, the other thing about these bonds are typically short term, 1 to 5 years. They're not 30-year bonds like a lot of corporations issue. So the duration of the risk is much less in terms of time as well. And so here's a comparison of some important characteristics of catastrophe bonds in relation to some other categories that are pretty well known. So all these numbers come from indices. This is not from actual investments. And so, for example, catastrophe bonds have averaged about 7% a year from 2002 to 2020 versus treasuries 1.3, high yield bonds at 8, and US equities. But what's interesting is take a look at the standard deviation. Now, standard deviation is a measure of risk. It's a measure of how much your return can vary each year from the average. And so look at the difference. High yield bonds, the amount of risk is almost 3 times that of catastrophe bonds, which is stunning considering you're getting, what, about 80% of the return on high yield bonds with cat bonds. And additionally, you'll see a measure here called Sharpe ratio. The Sharpe ratio is actually pretty simple to understand. It's just the ratio of the return to the risk. It's astounding how high the Sharpe ratio is for cat bonds. And also you can see that the dispersion of returns, the highest monthly return versus the lowest monthly return. Look at high yield bonds, minus 16%. One of the worst months for cat bonds, minus 6.5. And look at how many positive months there are in comparison to high yield. So you see the difference. You know, why we say, why use high yield bonds?
Yeah, so there's two different ways of looking at it. This first way is if you're just looking at apples to oranges to pears, comparing each investment by itself, it's already attractive. And then when you throw in the mix the correlation of cat bonds to US equity, which I think is the next slide you have.
Yes, it is. Yes. You want me to move to that? There you go.
Okay, so you can see the US corporate high yield correlation to the S&P 500.
Yeah.
They're in the middle. These charts are hard, I think, for people to read, Steve.
I know they are.
If you look in the middle of where it says US corporate high yield, and you go down, not to the first box, but the second box, it says 0.80, which means that it's 80% correlated with the S&P 500. When the S&P 500 goes in either direction, so does these high yield bonds. They're really a function of the same organizations. They're tied to the same organizations. But then when you look, but then when you, if you go to the first column and you look at the Swiss Reinsurance Bond Index,
yes,
compare it to the S&P 0.2 and high yield bonds 0.23. Wow. Yeah.
It's amazing. And what doesn't show in this correlation chart, because this is an average, it doesn't show you how these correlations, not for the reinsurance bonds, but for high yield, for example, increase, because then the correlations are not always static. They do change, but they increase dramatically when we experience like events like 2008, and also a year ago at the beginning of the onset of the COVID pandemic, when we saw the S&P go down about 30%, high yield bonds became almost totally correlated with the stock market, where once again, the reinsurance bonds did not become correlated. Now, there is some slight increase in correlation, and that study we mentioned earlier does show that, but it's really minuscule, very, very small. So you have something that really diversifies portfolio and really dramatically improves the efficiency of the portfolio, which we want to remind you again is the ratio of return in relation to risk. And isn't that always what we're trying to do? We're trying to improve the efficiency of a portfolio. And maybe, Laura, you want to mention how you gain access to this asset class?
Well, yeah. Again, this is something that is available to people that invest as institutions. So if you're an endowment or a pension fund, or if you're a fee-only advisor who operates as if they're an institution, we have access to these types of investments. This is not something that the average person, the retail client, has access to. And quite frankly, it would concern me to have a retail investor investing in this, because you do have to pay attention to what's going on. And we talk to the people over where we purchase these bonds. We talk to them on a fairly regular basis, and we understand what they're doing. And the minute we don't like what they're doing, we know we have to make different changes. But it's definitely a different kind of investment.
It is. And one good thing is we get we get a diversified portfolio and exposure to these bonds because we use a mutual fund, which holds many different types of reinsurance bonds with different maturity dates, different risks that are inherent in the purpose of the bond, so forth and so on. So we're very well diversified within this asset category.
Steve, we probably should say this is probably one of our mutual funds that we use. Every time we use a mutual fund, that means we're using an active manager. And
Yes.
a lot of you know that we don't like to always just use an active manager. Not all active managers perform. And so we like to be very, very particular about when we use an active manager. This is probably one of our more expensive active managers. There's
It is.
expense ratio, but still the net return that we're seeing from it. So we see the return minus their expenses, and we've still seen some great performance out of this fund.
Yeah, 6.8% return last year for 2020, which is quite phenomenal. And this year it's not quite as high so far. It's somewhat over, I think, about 2.5% for the year. But it's funny because sometimes you see the return comes in, it's a little lumpy the way it comes at times. Yeah. Now, we're going to back up a little bit here and take a little slight turn and explain to people why we're trying to use some of these alternative types of bond or bond-like investments. And that's because we mentioned earlier about how low interest rates are and what's happened with interest rates. And the fact that we think that the 60-40 portfolio, which if you go to Vanguard's website, historically has provided about 8 or 9% return. We don't think for the next 10 years is going to provide return anywhere near that, in particular because of low yield on bonds. And anybody here old enough to recall may remember how high interest rates were in the early 80s. I remember getting a money market fund that paid 19%. But what happened since the 1980s, we've seen rates gradually decline to where the level we're at now. And so bonds returned a lot because it has declined and also because of the yield they were paying. But now it's so low. The prediction is we're going to be lucky we see a couple percent from bonds for the next 10 years, which means that 60-40 portfolio, the return outlook has probably dropped dramatically from 8 or 9%, probably to 5 or 6%, possibly. Okay. And additionally, the risk inherent in bonds does go up because of the rates are so low. Something we call duration, which is think of it this way, is the average maturity behind these bonds has increased dramatically, which means you're going to be very, very sensitive to interest rate changes. So the risk in a 60-40 portfolio has also increased. And so that's why we're trying to find these alternative ways to invest in fixed income and other types of investments that create yield. Okay. And so I've sort of talked about this here. Laura, do you want to add anything to this?
Just that actually the search for additional yield was certainly one of the impetuses for us to find these investments, but that should not discount the benefit that we're also getting in diversification as well,
Yes.
which might have not been our first reason, but it's a tremendous, as we start adding these different asset classes to our portfolios and seeing how we're able to reduce volatility. And volatility is not our friend. We've talked about it a lot, especially if you're in a place where you're starting to take distributions and taking income from your portfolio. You do not want your portfolio to go up and down and sideways. And let's caution all of us. We all have to remember that this past, I don't know how many years it's been now, 12 years of just pretty much steady Eddie growth is, nothing goes to the sky. We are going to see more volatility. It's just a matter of when.
Literally.
Yeah.
And so anything we can do to try to make the portfolio more efficient, we're going to do.
Right. So that's what I especially like, is that protection there.
Yes, I agree with you. And so we also have another solution, which we'll be talking about in another video. That's alternative lending, which all we're going to do is give you a teaser right here. We're not going to mention what it is and what it means. So that means you're going to have to watch our next video.
I have to talk about also, which convertible bonds have been just a wonderful addition. So yeah, we have a lot more to talk about.
Yes, we sure do. Yeah. And by the way, part of our solution is we have reduced somewhat our allocation to traditional bonds, traditional fixed income, to try to make up for it with the reinsurance bonds and its alternative lending category. And by the way, what surprises me, Laura, is how that more advisors don't use some of these alternative solutions. They still seem to be trapped in a 60-40 model.
Well, first of all, you have to have the awareness and knowledge that these things exist in 1940 Act funds that are available, publicly traded on the exchanges, that are pretty liquid and pretty marketable, and you have access to it. So a lot of people aren't aware. And then once they're aware, it's not just awareness, it's think about the work that we put into finding these investments and doing our due diligence to really finding them and figuring out how we want to create representation in our portfolios. It's a lot of work. So
yeah, and trying to figure out math, and which we use mathematics, and trying to work the mathematics and try to figure out what the appropriate amount is for each asset class. It's complicated.
Right. So that's why I think they don't do it. But
yes, I agree.
Unfortunate, because they're missing out on, especially again, if things get a little rocky, you're going to see the difference. But
yes.
Anyway, we want to thank you for joining, and if you're still listening to our whole conversation here, we always want to invite you to also tell us some of the areas that you'd like us to talk more about. If you want to talk to us about reinsurance bonds, believe me, we can talk about this all day long. So feel free to contact us and let us know.
And I want to mention that if you are our existing client, let us, as Laura said, let us know what you think. And if you're considering hiring us, please feel free to reach out to us. And one thing we're happy to do is we're happy to take a look at your existing portfolio and see whether we can improve the efficiency of that portfolio.
Absolutely. So thanks again, and have a great rest of your day. Bye-bye.